Aloha, this is Kurt Nielsen with eMortgage Hawaii, and today I'm going to be providing you my forecast for mortgage rates for 2014. We're also going to talk about housing here in Hawaii. So just real quick, I'll give you an update on rates and where they are, why they've dipped down a little bit. I also want to quickly talk about the qualified mortgage rules that are now active and really what you need to know about them. They're really not that impactful. I think there's a lot more that was made out of it than there really should have been. So we're going to talk about that, and then I'll finish up with my rate forecast and forecast on housing for the nation and the Hawaiian Islands. So let's look at where mortgage rates are right now. We've had a nice little dip since the beginning of the year. We ended the year at 4.5%, and if you go back to my YouTube video from last year, that's exactly where we had projected mortgage rates to be at the end of 2013. But since December 31st, the rates have dipped down to 4 1/8 on the 30-year fixed conforming and at 3 1/4 on the 15-year fixed. Now, if you look at a full rate sheet of the conforming loans and jumbo loans, one of the things that you will see are jumbo loans aren't very much different from conforming loans. There's usually more of a differential between conforming and jumbo, and it's really tightened up. So usually we see 3/4 of a point difference in jumbo rates, and now we're only seeing just a slight difference, maybe an 1/8 to 1/4 point. Another thing that you should focus on is our ARM rates are very low. A lot of people are showing interest in the ARMs if they're going to be buying a property just to fix up and then hold on to for a little while and then sell off. Or if you're a first-time home buyer and you're not going to be in this home for a long time because you might want to start a family later, then the ARM might be a pretty good product. Again, they're much lower in rate. The 7-year ARM is probably one of the better products because you can qualify at the start rate on a 7-year ARM, whereas on a 5-year ARM, you qualify at the start rate plus 2%. So remember that if you're having trouble with a client qualifying and a 7-year ARM would fit their plans for the property, that's a good product to get them into for qualification purposes. And again, jumbo rates are exciting. They're low. They're going to stay fairly low. I think they're going to follow conforming rates for the year. So that's a good message to get out to your clients that are buying more expensive properties. So if we looked at the mortgage-backed securities market over the last 6 months, this is the Fannie Mae 4.0 bond. And remember, if the price of the bond goes down, that means rates are going up. If the price of the bond is going up, that means rates are going down. So beginning in late October, rates just started climbing up and up and up and up, really consistently right to the end of the year. And we kind of ended the year at 4.5%. And then since then, the mortgage market has really done really well, which is good for rates. So prices have gone up, rates have gone down. We're now at about 4 1/8%. This is not going to last very long, in my opinion. We're going to see kind of a roller coaster ride, but I do believe that rates will return to their slow rise, and we're going to talk about where it may end up at the end of the year. We're probably going to be well north of 5% by the end of the year. And this has a lot to do with what the feds are doing on quantitative easing. So we're going to talk about that here in a few moments. The next thing I want to talk about are just the qualified mortgage rules. They're really not that impactful. Lenders cannot charge more than 3% in points and fees, and that really hasn't been an issue unless they were gouging the client. A lot of lenders have gone to a 43% or less debt-to-income ratio. That's down from 45%. That is not part of the legislation for government loans like conforming, VA, USDA, FHA. That law did not go into effect, but it has been implemented by a lot of lenders, so we're going to talk a little bit more about that. All loan terms have to be 30 years or less. Again, that's not very impactful. I have never done a 40-year mortgage, so I don't see how that impacts anything. No balloon payments. Again, I haven't seen a mortgage with a balloon payment in years, and that's good for your clients. You don't want to see balloon payments anyway. So again, no impact there. No negative amortization loans. Those haven't been around for years and years, so no impact there. Really the only thing that is impactful is no more interest-only loans, and that's negative for those clients that might be interested in cash flow, maybe on a investment property or something like that. So, number 6 here is about the only thing that has had much of an impact. Again, we're going to go into the debt-to-income ratio issue. So if you look at the legislation, the 43% debt-to-income limit was suspended on all GSE loans. That's Fannie Mae, Freddie Mac, VA, USDA. So all conforming loans and government-backed loans, that 43% limit does not apply, and it's probably going to be extended, for another 5 to 7 years. So again, if you have clients that are above 43%, you need to work with lenders that can go higher, which we are one. We can get anywhere from 45% to 50% depending on what DO or LP, what the decision is on those underwriting engines. Okay, so we can, just be clear, we can go to 45% and sometimes up to 50% if there's good qualifying factors for the client. This is for all GSE loans. That's Fannie Mae, Freddie Mac, VA, USDA, FHA. Now, all jumbo loans that I know of now are at 43% or less. Again, I don't see that as a big impact because a lot of people buying very expensive properties don't seem to bump up against these income ratios anyway. So make sure that you're working with lenders that can go to 45 to 50%, especially for those clients that are tight on ratios, okay? And there are some things that we can do with clients that are, bumping up against these limitations, asking for some seller concessions to buy down the rate. Sometimes that can get them back into the proper ratios. Those things that we can help you with and coach you with. Okay, so let's look at the forecast for 2014 and what's really going to be driving the market. The most important thing is the Federal Reserve is planning on ending QE3, quantitative easing 3, by the end of the year. This is going to remove $85 billion a month in mortgage purchases by the Federal Reserve. That's huge. The federal government since about June or July has been buying almost 90% of all conforming loans. Now, when they get out of the market, somebody has to fill in. And generally, those are the foreign investors that kind of left, I think, around May, got out of the market just because rates were so low. So as interest rates rise, those foreign investors will get back into the market and begin buying mortgage-backed securities and replacing the Federal Reserve. But we need higher rates to attract those investors. Also, another thing that we need to keep an eye on are housing starts. We have been really struggling to break 1 million housing starts, on a month-to-month basis in 2013, and I think we're going to still have that problem in 2014. And remember, we need about 1.5 million housing starts a year to keep up with the growth of our population and the deterioration of homes that are no longer livable. So we're so far below what we need to be just in the construction business that I still see a fairly tight supply through the end of the year. And when people start talking housing bubbles, I just don't see that happening. There's just not enough homes being built to cause some big bubble. And this is really because the banks have been slow to re-enter the construction lending business. So builders that want to build homes have a difficult time of getting loans, so they can go out and build those spec homes. And remember, it's the small builder, that builds 3 or 4 homes a year, 5 homes a year, that is the mainstay of the construction business. So until they get credit, I don't see, housing starts really rising until the banks really do loosen up. We do expect the economy to continue its slow recovery, but it's not going to be anything to write home about. It's just going to be a continued slow recovery. And again, also job growth will be very slow but progressing throughout 2014. So these factors will put pressure on mortgage rates, throughout the year. Of course, you're going to see dips and valleys, and and spikes, but generally we do see rising interest rates throughout the year. And remember, in 2013, we started the year with a 30-year fixed at 3.0%, and it ended at 4.5%. That's a 50% rise in mortgage rates. And it really didn't have a huge impact on the demand for homes. So we're still going to have interest rates rising, probably, up into the 5% range. But I don't think that will take away from the demand for housing. And certainly it's a message you need to get out to your clients that if they don't like rates right now, they're certainly not going to like rates at the end of the year. So this is an interesting little graph I wanted to share with you. This black line here is the Federal Reserve balance sheet. And this spike was the beginning of QE1, then another spike of QE2, and then this spike of QE3. And after the Feds ended each of these quantitative easings, you can see this yellow line is the stock market. At the end of every quantitative easing, we had a dip in the stock market, and we're probably going to get the same thing happening, and which may be happening right now, is that now that the Feds have announced that they're backing off on quantitative easing, that the stock market will react, but then it'll resume its continued growth. So we could see a retraction in the stock market, which helps mortgage rates. That's exactly what's happening right now. Is we've had a dip in the stock market, there's a flight to safety, people start buying mortgage-backed securities, the price goes up, rates go down. So, but overall, I believe that the trend in mortgage rates will be for higher rates throughout the year, but we will have these, peaks and valleys. This is the chart on housing starts. I just wanted to point this out to you because this is so important on the demand for housing and the supply of housing. I think supply of homes will remain fairly tight, a little bit of loosening as rates go up, but as you can see, over the past 30-some years, we've rarely been under 1 million home starts a year, and it only happened really in 2009 when we went through our crisis, and we're still not back to 1 million homes being built a year, and we really need to be up here around 1.5 million. And this issue right here is what is going to keep prices up and a tight supply. And until we can get the banks to loosen up on construction and financing, you're going to see a tight housing supply, and I don't see any way around that. Okay, so our forecast for housing for 2014, if you looked at the Case-Shiller index, that's the average price increase of homes in the top 20 metropolitan areas in the country. The last reading was up 13.7% year over year. We just do not expect this to continue. I think the escalation in housing, certainly single digits in 2014, and maybe around 5%. And that's not a bad thing. I think that you don't want to see such a dramatic rise in housing, because that does tend to create bubble opportunities. In Hawaii, Oahu ended 2013 with a 3.8% year-over-year rise in home prices. Oahu recovered very quickly from the downturn, and Oahu's housing prices are now above the peak back in 2007, and that's why they've slowed down a little bit. Buyers are looking at the neighbor islands, and because homes are cheaper on the neighbor islands, that's why the neighbor islands have been rising quite a bit higher than Oahu. But I expect that similar performance in 2014. Nothing dramatic. I don't think we're going to dip down to a 0% growth, but really certainly somewhere between 0 and 3 or 4%. If you look at Maui, Maui ended the year 13% year over year in rise in home prices. And again, I don't think that's going to continue. I think we're going to follow the national trends, maybe 5 to 7%. Really depends on some foreign buying, and that really depends on the currencies, how strong the dollar is. Same thing with Big Island and Kauai, 13% year-over-year rise. And again, I think that we should see this settle down a little bit, But when you combine, a 5 to 7% rise in home prices with a rise in interest rates, at the end of 2014, people are going to be paying a lot more for their home if they're going to be borrowing money. We are projecting the inventory on homes to rise slightly. Right now we're at a very low level of 4.3 months of housing inventory. That probably rise up a little bit as interest rates go up, maybe to 6 to 7%, but that's more normal. So hopefully a little bit of a loosening. One thing that we will see, and this is nationwide, are people that were upside down on their property and had negative equity. As home prices have risen, they're getting into a positive equity area again, and that allows them to free up and sell their homes and move to where they want to be. So maybe they've been trapped in their home for 5 or 6 years because they've been underwater. As they finally get into positive equity, they're able to move closer to work or closer to the kids' schools. So we're gonna see this across the nation over the next 2 to 3 years, is finally people getting up and moving, and especially the baby boomers who are retiring, want to downsize or move to more warmer climates or something like that to Hawaii. I think you're going to see more demand for that too, and hopefully we're going to see construction lending picking up. I do believe it is loosening. We currently are offering lending on spec homes, which I never thought that would ever come back, but we do have speculative construction lending back. So if you have clients that are interested in that, certainly have them call us. Okay, so our forecast for mortgage rates, we believe that quantitative easing will drive rates up. We probably get to that 5.75% by the end of 2014. And this is more normal. Again, I think if the Feds weren't in the market right now, interest rates should probably be up around, 5.75%, 6%. That would be where the market would be without them buying up all these mortgage-backed securities. So, now think of the impact on this. If you have a loan of $625,000 and the payment rises, from $3,077 to $3,650, that's a 19% rise in payment. Buying power is going to drop over 20% when you combine the rising rates, lower DTI, and the increase in home prices. So, when you combine all of these factors, this is a loss in buying power of, this example of over 120,000 years. So these are going to have an impact, and that's why ARM loans are going to come back into favor. I do see, the 7-year ARM is certainly coming back with a lot of clients, and especially because of the lower interest rate for qualification. So, again, the message that you need to get out to your clients is they need to start looking forward, not backwards. If they missed the boat on 3.5% 30-year fixed rates, well, that boat has sailed, and we have a nice little dip right now. It's not going to last too long, and rates are going to resume their rise, and again, we're going to be up into that 5.5%, 5.75% range by the end of the year. So it's an important message to get out your clients, get them off the fence, get them into their property. So, okay, that's it. I do have an improved mortgage calculator for your smartphone. It's a really nice system. Shows you where current mortgage rates are on 30-year fixed, 15-year fixed, and the ARMs. It also shows you the difference in mortgage payments on conventional FHA, VA, and USDA loans. So if you want to upload it, just go to this address and click on your forward button, add it to your home screen, and then it'll get added to your smartphone. Enter your name, email address, and cell phone number. Let me know how you like it. All right, thank you very much, and I'll look forward to my next mortgage market update next week.